Today's Weldon Live, global macro, perhaps one of the most important days we've seen in quite some time. The FOMC to decide on the path of Fed funds today, and perhaps more important than the actual change, if there is one, in interest rates, it's what they have to say about the future slope of interest rates, and potentially if they were to make a comment on the dollar. And I've heard really no one talk about what if they comment on the dollar. It's not their purvey, it's the treasuries, I get that. But the problem here has been the dollar's rally predicated upon thoughts of tightening. If they raise rates here, the risk is the dollar goes higher, and this exacerbates the problem with emerging markets, commodities, and becomes deflationary and works against the Fed's own objectives of reaching a 2% PCE, 2.5% CPI inflation rate. Let's take a look at where we are going into the meeting. The appropriate timing of policy firming at the June projections, clearly 88% of Fed members saying it's this year. Okay, they are looking for one, if not two, rate hikes this year, according to the June dot plot. Okay, the FOMC's own forecast for future interest rates. Each dot represents a Federal Reserve member, and this is their vote as to where you would be, or their forecast as to where you would be in Fed funds. You can see for next year, it's wide. I mean, we're looking at one hike and done by one member. We're looking at one hike and not even close to done. You have two members saying 275 by next year, by the end of next year. The bottom line is we use the median to best we can, and looking at 175 for next year, 275 to 3% for the end of 2017, and 3.5 longer run, let's call it 2018. And this is what's behind the dollar's rally, because at the end of the day, the official rate, LIBOR, cash rates, any of the funding rates, they haven't moved at all. So all of this dollar rally is predicated upon expected future rate hikes that have not yet occurred, and if you don't get them, what does that mean for the dollar? Well, this is really interesting. We're going to really dig into this. Bottom line, the market does not agree with this slope of movement in Fed funds. Fed funds future for the end of next year, below 1%. Fed funds future for the end of 2017, below 1.5%. Now let's go back here real quickly and look at this, because frankly, if you go back, you were looking for a 2% Fed funds by the end of next year about a year ago. That has been whittled down by more than half by the market to below 1. You're at 1.5. Here's where the Fed is for 2017. Here's where the market is. Less than half of what the Fed is projecting. So we overlay the market's projections based on the Fed funds future in blue against the dot plot from the Fed. And wow, this is a big difference. And the problem here is that the market's already priced in an easing in the dot plot, if you will, which thus doesn't represent any real monetary easing at all. And this has been our problem, because it's all well and good to work the forward expectations tightening to get yourself some room to ease if you need it, but it's really not an ease, because official rates are still right here. Short-term rates, although LIBOR's gone up a little bit, are still basically right here. Commercial paper rates, the overnight rates. I mean, anything you want to really look at in terms of, funding in the near term, 3 months or less, right here. They haven't moved at all. The expectation is that they will move, but the market's expecting only half as much. And again, this has come down. The market has, and even the Fed has come down some. So the real key to today's meeting is how much might they come down here, and here, and here, and even here, because they're pricing in 2 hikes against the market's maybe 1. It's a 2-to-1 odds of 1 hike for the December Fed funds futures. It's about a 65% probability. So there's some probability that you remain at 0. Now let's look at the balance sheet, because the balance sheet, here's the balance sheet. Here's QE3, here's QE1, QE2, QE3, and then taper, and then tap out, sideways, gone nowhere, actually down from the February high ever so slightly. So the balance sheet has actually contracted in the last 7 or 8 months. Here is the projection had they maintained the pace of QE3 without tapering. I mean, it'd be a much different picture right now. Now, what's interesting is, watch this compared to the stock market, which has gone sideways. What if the stock market were up here? You think we'd be having this discussion? No, they'd be tightening. They would absolutely be easing. And there's why. Here's the Fed funds balance sheet. What we just looked at here. What we just looked at there is also here. So this rise was in response to the big decline in markets. And now look at how the balance sheet has led the stock market higher, has facilitated retail sales growth based on consumer credit expansion, borrowing by the consumer against the paper profits in the stock market. Okay, so you replace the housing market with the stock market from 2004, 5, and 6, and 7, when mortgage equity withdrawal is now consumer credit predicated upon a wealth effect in paper unrealized profits in the stock market. Well, what happens the second taper goes to tap out? You've got tapped out in terms of the stock market reaction. Look at the previous occasions they've gone to tap out. Let's tighten this chart up a little bit. Here's the balance sheet. Here's QE1. Here's QE2. Here's QE3. These are the times the stock market's going up. What happens when they go to tap out? Stock market goes down. Had it not been for the ECB and BOJ's participation, you might not have been bailed out here in terms of 2011. This was the debt ceiling crisis. This was the European debt crisis, U.S. debt ceiling crisis, European debt crisis, which facilitated LTRO. It was the same time the BOJ stepped up the pace. Well, guess what happened? That had an impact. As soon as you kicked in QE3, you're off to the races in the stock market again, all the way to the peak, which corresponds with the tap out by the FOMC. Had it not been, frankly, you might have tapped out earlier. Again, not have been for the ECB's QE3 trillion and the BOJ's expansion to 80 trillion yen per month instead of 60. Well, that's all now priced in. And what's happening now that you've gone sideways to down slightly in the Fed's balance sheet? You've gone down in the stock market. It's not coincidence. It's not coincidence that the growth in retail sales is slowing. The only thing not slowing is credit growth. You have tap out in the stock market returns. It's all well and good to be at new highs, but you're not getting any return here. This is the problem. And in the past, when you've been at record highs in the stock market, the 6-month rate of return has been 25% or higher. You've been around 5 with the most recent new highs. Not only that, but you look at technically, it's gone nowhere and technically stretched to the max. You're through this channel line that was very sustainable during QE. Okay, now you're above it, you come back below it, you're still at the upper end of it, you're below the 52-week moving average, which is rolled over, you held the 2-year moving average for now, okay, the stochastic indicator, a great momentum indicator, has been tapped out to the max. I mean, this thing has been as high as 94 for weeks running, it's a weekly. This is virtually unprecedented. The peak here, even in 2007, you go back to 2000, not even close to the degree of momentum stretch and extension that you have here. Oh, here's your rate of return. Bearish. You're now negative rate of return. You were just at record highs. You're already negative on the year-over-year rate of return. This market is not out of the woods by any stretch of imagination, and the simple fact that the Fed doesn't hike today is not going to be enough to drive this higher. Why? Because they're not expanding their balance sheet. Case closed. Okay? Dot plot easing is not a real easing. Okay? Because interest rates are where they are at the cash level. They're not going lower. They're not going to be cut. It's not going to be QE result today. Okay? Unless they make a comment on the dollar. That's why, to me, this is a wild card. That's why, to me, this is something you need to pay attention and be potentially prepared for. Now, they raise rates. Well, mortgage rates are already showing signs of breaking out. This is all well and good, if the housing market were healthy. Is the housing market healthy? Well, prices might suggest it is. The problem is it's not enough homes being built. And while demand is up, demand is not strong. That shows you how low the level of home building is. Because demand is not really that strong historically, but it's higher than the level of new homes being built. Thus, prices go up and price out the first-time home buyer. You look at MBA, refi, and purchase indexes. Have they rallied off their lows? Yeah, they have. Do they have decent percentage gains in the last 2 years, 3 years? Yeah, they do. The problem is they're still like 60, 70% below where they were at 2007. They're still barely, not even half of what they were in 2005, 6, and 7. So to suggest that the market can withstand a rise in mortgage rates here, a normalization, let's call it back to 3.5 from 2.5, I don't know about that. Here's your downtrend, okay, and here's your breakout in the Fannie Mae benchmark 30-year MBS yield. Here it is from a longer-term perspective. You're talking 6.5, all the way down to half. then up to 375, now down just below 2, and now you're rolling to the upside, breaking out, breaking trend lines. If this is a whole, ABC 61% retracement of this rise suggests the next move would be above this high, and when we use the close only chart, you're above the 52-week, which is turning up. You're targeting 3.5 and potentially higher should this get some legs from the Fed. Going to be deflationary. Let's talk about the dollar. Again, the key to all of this based on the dot plot. You scale back the dot plot, maybe you scale back the dollar. The problem is the dollar's run so far, emerging markets are really hurting now. And a dot plot pullback, I don't think, is enough to bail out emerging markets because you're talking about needing growth, not sideways. You need growth, and you don't have it. Here's the trade-weighted dollar index. Is that a new high? Is that a new high going back to the early 2000s after a double bottom at the 38% retracement of the entire rally here? Okay? Here is the year-over-year rate of change in the Fed's trade-weighted dollar index. Every single time it's above 15% on a 12-month basis, you have intensified macro market turbulence and intensified deflationary pressure. You have it here, no doubt. Now, what's interesting is the forward markets, okay, again, depricing the dot plot, okay, in the futures markets, much less hawkish than the Fed's dot plot is, all right, so already easing for the Fed on the dot plot, and I can't believe we're using these phrases because it's, really kind of fraudulent to say dot plot easing, but we've been saying this since they started verbalizing expected interest rate hikes, that it was a puppeteering move, that it was a verbal tightening, not a real tightening. Now you're going to get a verbal easing, not a real easing. It's kind of the same thing. When we look at the forward markets in the euro currency's deposit rate discount, flip it for the Fed's dollar-induced premium in forward interest rates. This is the end of 2017. You can see it's narrowed, and that has stopped dollar-euro from falling, dollar-yen, dollar-Swiss, sterling, okay? But it has nothing to do with the reality facing emerging markets, with the deflationary impact that this expected rate dynamic has had on the dollar as it applies to commodities and commodity exporting countries and emerging markets. Their currencies are getting trashed. They continue to get trashed, and this is a crisis right in front of us. And going back to this, above 15%, and thus you have an budding emerging market crisis. Look at these currencies. These are Asian currencies. These are the South American currencies. We wrote Peso Wars, a 200-plus page report in January of 2014, in which we said you have a currency crisis coming. And it's coming from the Fed, it's coming from commodities, it's coming from deflation, it's coming from the end of QE. And that's exactly how it's played out. Peso Wars. We started with the Argentinian peso and extrapolated out from there. Here's South America. We included Eastern European currencies. We talked specifically about the Kazakhstan tenge and said we look for big moves. It was 3 weeks later they devalued it by 20%, and look at it now. Just in the last few weeks, it has come unglued completely. All of these currencies on the mat, Eastern Europe. Even African currencies. Look at what's going on in Zambia right now. Wow. I mean, this is an across-the-board, broad-based, commodity, deflation, Fed interest rate, dot plot-induced, rise in the dollar-driven emerging market crisis in foreign exchange. That then translates into pressure on the stock markets there. Here is the dollar inverted. So when this blue line's going up, it means the dollar's going down. So dollar depreciation, reflationary, draws the CRB and commodity prices up, draws emerging markets up, led the way prior to the crisis, led the way out of the crisis, and since 2011, everything has changed. And the dollar strength here, predicated upon dot plot tightening, has driven commodities lower, which has now caused emerging markets to plunge. It has been no QE3 reflation in emerging markets. The emerging market stock index in red, the S&P 500 here in black. You see the result. Since 2011, S&P's kept going higher, but has done nothing for emerging markets at all. And most recently, because of dot plot tightening, has really hurt them. Another way to look at the dollar is to use the gold price adjusted value of the dollar. And this gets really interesting because it's a totally different picture when you include the price of gold. When you talk about the real purchasing power of the dollar, not the dollar relative to dysfunctional emerging markets and commodity exporting currencies. Okay, let's consider it against the purchasing power of the gold of an ounce of gold. Okay, so you can see it is directly related to Fed. Okay, Fed's easing, Fed's printing money, gold adjusted price goes down. Some of that's dollar depreciation, some of that's a rise in gold. It's been the flip side now. When they started talking taper, that's when the dollar took off. That's when gold started getting hurt. Why? Because dollar rise off of no more QE is deflationary. We look at it from a longer term picture. I mean, the dollar's really, this has been a huge move in the dollar in emerging market currencies. Relative to gold, it hasn't. Now, what if this were to, really get the juices going to the upside? Well, that would be a policy error dynamic based on the Fed hiking rates, based on, no dot plot easing, based on the fact that gold is vulnerable here to a policy error, and would be an amazing tell either way. Okay, Fed policy success in achieving their objective, if they're really honest about achieving an objective of 2% PCE and 2.5% CPI and 3.5 to 4% wage growth, then you're going to take out 1307 and be clear of all the Fibonacci's going all the way back to the delinking of gold from the dollar. Okay, look at where you've held. I mean, Fibonacci heaven galore, 50% retracement of the move from the 1999 gold low. Okay, you reversed up. You're trying to hold the 10-year moving average here. A move below 1070 in gold would be, really technically devastating, and would come in line with further increases in the dollar and a push higher to, again, look at where you were back in 2000. I mean, this dollar rally seems huge when you compare it to gold. Even with the decline in gold, it's not huge. That may speak ill of gold if you have a deflationary error here by the Fed. And that's pretty interesting because we want to like gold, particularly with what's going on in emerging markets. You look at gold in Brazilian reals at a new high. This tells you how much of a dollar dynamic this really is, and how much of a mistake it might be for the Fed to, adopt a policy that further exacerbates the appreciation in the dollar. This is why, if they do hike, we think there's a chance they may make a comment on the dollar. And wow, wouldn't that make things interesting, particularly for commodities? So we're on alert here in commodities. Here's the CRB index. It's an A, B, C, 61% retracement going all the way back to the 1999 secular low in the commodities markets. You need to get above 406 here, 407 here, and you got 415 as your 6 month. Really, you need it above 440 to get going. But look at this. I mean, this is at levels that in the past, it's actually lower than levels except 1999. Could this be a 1999 low in commodities? If the Fed doesn't hike and they deprice plot and they actually make a comment on the dollar, that would be a boon for commodities. We're not saying it's going to happen. We think the timing may be a little off here. You may have sideways first before you get some shake, and stock markets may have to go lower to induce all of this. I don't know. This is the hardest meeting we've had to handicap in a long time. Do we think they should hike? No. Do we think they will? We think they could. And then if they do, it's more about what they say about future hikes, and wow, if they might make a comment on the dollar. Again, the wild card here. So we're watching commodities. Now, a little bit of self-serving marketing. We have taken a couple of years using my proprietary algorithms that are the trend trackers that many of you are familiar with, okay, that have worked over years and years and years of identifying trends, both bullish and bearish. We have put together and spent literally years putting this together, backtesting, adjusting, not fitting, but adjusting and making adjustments more to the portfolio and the leverage dynamic, and coming up with a non-leveraged, typical, old school hedge fund type of thing where it's 100% long, 100% short. Now, you're not always, but the goal is to be, seeks to take 100% long, 100% short in the trendiest of commodities, okay, in only commodities, using no leverage at the $4 million account size. Now, it's a high minimum because there's no leverage. Okay, and we have a very risk-averse approach. So if you want to, potentially have a 5% position in something and have no leverage, okay, a 5% position in gold at, at $1,000 an ounce, you can do the math. It requires a high minimum investment. This is why we're looking for seed capital. We have not publicly marketed this program at all. The track record of this program is very, very solid. Okay, you can look at the numbers here: worst year, best year, year by year, month by month. Okay, yes, hypothetical has, potential for slippage, but the returns are so robust, it can afford a little bit of reality slippage here. Not only that, but as of 2011, last time we updated this chart, and we're working on updating a new one, but just kind of including this morning on the fly, you can see our long-short program was at a low in 2011. It's been up since. Gold has been down, S&P has been up. relatively speaking, far, far outperforming gold, the S&P 500, and even the commodity sector itself, because we're able to be long and short. And that's on a non-leveraged basis. Here's the, since we finished the backtesting, the theoretical performance over the last 3 years, positive. And then here's the return this year, 10% right now, with a huge return on margin, of course, because it's a non-leveraged program. But here's your month by month. We kind of think that right now the time is ripe for this kind of investment, and we are actively seeking seed money in the amounts of $4 million from investors to kick this program off. As far as Fed's meeting today goes, wow. I mean, on the edge of our seats, as is everyone else out there is. So much transparency, so much uncertainty. The Fed has done themselves a disservice by being so transparent. And right now, anything could happen.